Greetings, it's Dr. Jeffrey Scott, and this is my weekend market update for Sunday, September 4th, 2022. For those that are new, if you like this, please let me know by hitting the up or the down thumb. Obviously, the up if you like it. Hit subscribe, the alarm, you'll be notified when I do these again. My email address, if you want to send me direct, is hgsidoc@gmail.com. And I titled this week's review Heading for a Retest, which if you've been following me for any length of time, that should be no surprise. Disclaimer, this is for education purposes only. Anything I talk about, recommend, should be considered education and not investment advice. I'm a doctor, not a broker. Tools demonstrated are those I use in my daily trading. I've paid for all the tools I use. Trading involves risk. You're only solely responsible for any investment decisions you make. And I may mention options, and if you're not familiar with them, even if you are, you need to make sure you know the risk, have had education like the Options Industry Council website, and consult your financial advisors. I'd like to once again remind you that the next Wealth 365 event will be October 10th through 15th. I'm not sure when I'm speaking. Typically, I speak early in the week and then again on Saturday. A lot will depend upon how many folks Rob Hoffman has coming and where he wants to put me. Please use my link, just so, not that I get any financial credit, but I don't have a mailing list or anything, and I'll have this underneath the intro under more in the YouTube site. The other thing to point out is if you like these videos, I put things like this up almost every morning at stocksanddocs.com. Plays off the fact that I am a doc and this is about stocks. So, speaking of stocks, I used to do this before COVID on an annual basis, and I'm announcing tonight that I will be doing this again. It will be most likely December 4th and 5th in Palm Beach Gardens, which means you fly into West Palm, or if you want a 45-minute drive, you can fly into Fort Lauderdale. I typically do it right after John Person's meeting, which is December 2nd and 3rd. I'll be seeing him over the weekend and make sure that I've got the dates right, so I'm not sending anything out official, but I'm pretty sure those are the dates. There'll be 2 days of education from the minute we start on the 4th till I dismiss you on the 5th. I'll cover everything, all your meals. Basically, we'll go to a steakhouse that night, drink some good wine, eat some steak and fish, and during the meeting I'll have breakfast and lunch and lots of snacks. I record these for those that attend the meeting, and I'll be using Wealth Charts, HGSI, Edge Rater, the Q Tools, TradeStation, TOS, and whatever else you guys ask me to work with, because I pretty much have most of the programs. So more info to follow, but several of you have already reached out to me. If you're interested, please just drop me an email so I can put you on the mailing list to send out when I get the final stuff. And if you have thoughts on a second speaker, and if you are going to be attending John's meetings. So hgsidoc@gmail.com. Now let's go on. Let me close that. All right. For the interest of time, I usually start with a spreadsheet that has most of the other programs that I might get bits and pieces from, and I get through it very quickly. So let's start with the markets. This is taken from HGSI, where I have a view that's archived that I store every weekend, and then a view called Off the Lows, which is what I usually use for this presentation. In yellow are the major market indices. So let's start with the 1 day. And you can see for the 1 day, the dollar was flat, commodities and gold were up, oil was up, bonds were up, silver was up, Bitcoin was up, and the surprise was that the IBD 50 ETF, small cap growth, actually was stirring. However, over 5 days, you could see the only things that were up were volatility and the dollar, and that is not something that's good for an equity investor. You could see Dow minus 2.8, NYSE minus 3.2, Spiders 3.2, and then Russell, NASDAQ, and the Qs were all down over 4%. So a very tough week, continuing on the bearish sentiment after we realized that the Fed doesn't have a put on the market, and they're going to continue to raise rates, probably longer and beyond what people expected. Now, if we look at off the 52-week highs, you can see that the small caps and the technology stocks, the Qs, are down over 25-26%. S&P is not quite in bear territory, only down minus 18.3. The Dow and the NYSE down 15. Any way you dice it, slice it, the markets are in pretty tough shape. Now, over here, and this may be telling of how much more downside we have in the short term, these are the recent lows. So if we have a retest, this is how far we're off the lows. So here's the dates, how many days it's been since the 52-week low was hit. And you could see on big caps, we have 5 to 8% we could drop, and 10 to 11% on the small caps and technology. So a retest of the lows, which I think is potentially in the cards, could be as much as another 10% down before we ask the question, will the retest hold? If I look at the Q tool, you could see a couple of things. You could see here that on Friday, 91% of the sectors were negative, 84% of the industry, and 80% of the stocks. The only sector that was up on Friday was energy. When you look over 5 days for the week, all sectors were down, nearly all industries were down, and 94% of stocks were down. Pretty tough week to make money to the long side. Over 10 days, it looks almost identical, and you could see over the last month, 91%. So all but one of the sectors has been down over the past month, 82% of the industries and 75% of the stocks. Just shows you how rough this market is. This is a real-time version of the bucket. Since it's end of day on the weekend, I'll look at it in EdgeRater, but I call this a left shift, where most of the stocks are in the lower part of the Bollinger Bands, 80% below the midline, and you can see we're starting to clutter down at the bottom and below. That's when reversals occur. Not there yet. The warehouse view, here's 0% return, except for this little bump here to plus 1% in the middle of the pack. For the most part, this was a very negative week. You could see, if you look at EPS rank, which gets bigger to the right, and you look at percent return, which gets worse as you drop, no benefit of earnings. Relative strength maybe fared better than poor relative strength, but it was all negative. Prior group rank strength did not work. In fact, it was better than no good group rank in the prior week, but boy, it was still pretty negative. It's just a horrible week across the board. If I look at my Hindi worksheet for the NASDAQ, again, until we see new highs, I wouldn't expect to see a Hindenburg omen. But what I am seeing is a return to the high numbers of stocks at 52-week lows. And you could see in the NASDAQ, we hit 7.59% on Friday, 7.7 on Thursday. That's bearish. The weekly bongos have also flipped. NYSE is just as bad, 6% on Friday, 6.8% of the NYSE hit new lows, 52-week lows on Friday and Thursday, and you can see the weekly bongos in play. So the markets have rolled over. I haven't shown you anything that should give any interest to the bulls until we get here. Now, this is what we look like at the June lows. June 17th, you could see 20% below the Bollinger Bands, a little bit over 30 in the lowest decile, meaning between percent B0 and 10. Now, if you add those two together, you're at about 55. We're at 50 right now if you add the lowest decile within the bands and below the bands together. So we're getting close to a point where you should expect somewhat of an oversold bounce. Will we get it before we get down to the June lows? We'll see. I'd love it if we do. I don't want the market to go down. I want to be bullish. I want to buy stocks. Just not yet. And then here's where we were a week ago, and you can see we're at 28% there, where we're 50 if you combine the last two, and you can see we got significantly worse on stocks below the midline of their Bollinger Band. So this is looking at a large number of stocks, 1,500 give or take in the S&P 1500. Energy on the week was red, and I think part of why the market sold off after initially looking good on Friday was the European natural gas fell as is the Russians, is it working? Is it not working? They're all over the place. But you could see the European natural gas has been on fire year over year. And notice that across the week, U.S. Energy was down across the board. Oil down 5 to 6%. The only thing turning positive on the week, which was still down on Friday, was uranium. On the metals front, look at the weekly, everything is minus. Ore was down almost 10%. Wowzer. Now down 16.24% on the month. Strong dollar, bad for metals. And if you look at the Baltic Dry Index and you go back here, it's the lowest it's been. It's a 52-week low, and certainly the lowest has been since the beginning of the year. For people that like dry bulk shipping, not a good sign. Now keep in mind, there are shippers that ship petroleum products which are doing fine, Scorpio, and I think Ardmore is another. And then there are those that do dry bulk like Star Bulk, not so fine. Interest rates in white on the 10-year and the 30-year spiked higher. This was the top back in 2019. We bounced or saw resistance there earlier this year, or actually in 21. So it'll be interesting to see if we can get through that. Actually, that was 2022 earlier this year. We'll see if that holds as resistance again. Now back here, credit spreads, the treasury markets, the credit markets are still tight. That's why this is elevated. That's not good. And then the other thing is, if this is a recession equals bear. Notice how these occur after we start to go higher on the yield curve. And we've been beaten up for months, and the yield curve is still negative. What happens when it starts to improve? If we get that recession, maybe this is telling me it's coming, and we haven't had it yet. Overbought, oversold, stocks above the 200, stocks above the 40, both reversed off of their recent highs, but neither are in a land of must reverse. And even the T2121, looking at 13-week new high, new lows, really isn't at an area of clear reversal. So most of these are not telling me that a reversal is imminent. Economic news this week, it's a lighter week. We got the Labor Day holiday on Monday. We got some PMI and ISM for August on Tuesday. We got Loretta Mester speaking 8 a.m. on Wednesday. Beige Book Wednesday afternoon, and jobless claims on Thursday. So a medium, I guess, week of news. Not giant, but still plenty of there to move the market. Earnings are slowing down. There's still some good-sized stocks left. Coupa Software, Neo Electronic Vehicle, GameStop, everybody's favorite meme stock. DocuSign, another big one. Let's go Krogering, etc. Expected moves last week. Again, we got below. Here is on the ES. Here is on the NQs and the YMs. So the market makers and on the Russell lost again if they were selling straddles at the money. Didn't lose much because their premium covers the difference between the gray line and the red line, but they would have been negative. The the VIX, despite the negative market, didn't do that much, at least looking at the VXX. Maybe I need to change that to something else. And then the dollar itself closed in the upper half, but did not go outside their expected move. Thoughts: market sold off hard for the second week in a row. Powell hawkish sentiments hanging over the market. August employment report was not weak as expected or hoped, putting a dent in the softening inflation narrative. For the week, look at how much the major indices were down. That's big. Third straight losing week. Then you had NVIDIA and AMD giving warnings that because of some new regulations, executive orders about shipping certain semiconductors to China, that they would have significant revenue shortfalls, bad for tech. All 11 sectors felt on the week. And number 6, my thoughts on the market. It's certainly possible that we get an oversold bounce soon, but it looks like we're heading down to June lows. And if they don't hold, then do we retest the 2020 pre-bear highs? And that will hurt. We are getting oversold, and perhaps with lower news flow, we can get a holiday bounce. Typically, we see growing market participation after Labor Day as the pros come back from the Hamptons. Will they rescue the markets? I don't know. For me, it's still about raising cash. You can play long, you can play short, but play with small size. And those that don't want to do that, stepping aside and waiting till it's better market conditions, you'll probably have more money than those that trade as far as a percentage of portfolio left in 2 months. And September can be just as tough as August. Again, just to remind you, this is an awesome opportunity to get wealth charts at the lowest prices that it's offered during the year. Hear from Rob Hoffman and many other speakers, 50, 60 different speakers, many of which, including myself, offer their packages for wealth charts only during these events. And hopefully you'll be there, and hopefully you'll get to come and watch me do my thing. And I think, and just one more reminder, Stocks and Docs. Stocks and Docs. If you haven't been there, please come and visit. And nothing, no cost. They ask you to register so that they can send you out invites when I'm doing programs. Other than that, a free video every day, which is sort of a mini version of what I'm doing here. Now let's look at the markets. So I'm going to start with hot stocks on Wealth Scanner, top-down indices. So this is a bunch of ETFs and markets just to get a sense of what's working. Just to show you how non-bullish this market is, the only thing that had on the bullish scan that had a flame here was GDX. And you could see if you look at the very short term, GDX, which has been negative, the day trading one moved up quite a bit on the end of the week, and that was enough to trigger the flame. So that is it of showing bullish movement. Not a very bullish time in the market. And if you look at GDX, and maybe it's time to think about gold. You had a reversal day, gap up is up 3%, but you're talking about something, and we'll talk more about gold, that's just been a major downtrend for quite some time. I always like to start the indices, and let's look at the spiders. And you know, the narrative for me for the last week has been, we failed at the 200, we failed at the 50. Why wouldn't we expect a retest down at the June lows? That's what my expectation is. I would love to be wrong. I like to do a 3-road scenario. So let's talk about what that 3-road scenario is, something that Ian used to teach. So, you know, maybe we bounce around a couple days and then we get some good news. We go out to new highs. We'll call that scenario 1. Now, I wish that would happen because, as I commented before, I kind of prefer to be bullish than bearish. I think that's low likelihood. What could happen is we could bounce around a lot and then get back in here and sort of bounce around between the 50 and the 200 and sort of build a base. I'd be okay with that, and that's scenario number 2. But then we get to scenario 3, which is probably the most likely one. You look at what we're doing here and what's going to stop us from moving down here and retesting those June lows. I think scenario number 3 is the most likely. Now, of course, it's going to bounce up and down, not go down in one shot. Then what is it going to do here? Is it going to bounce and start a recovery like we saw here? Or is it going to go down and God forbid we start to visit the lows from 2020? So I don't know where we're going, except to say if I was a betting person, we're coming down to test this yellow line. We will see. Notice how much volume we had on Friday on this sell-off. So spiders look weak. Let's talk about the Qs. Do the Qs look exactly the same? Let's take a look. Yeah, they do. Now, is this a potential area of support? It is. Notice if you go to the left, it was support here and then resistance. So this could be a natural place to bounce, but we also had a big sell-off on Friday on big volume. So in a bearish engulfing pattern on a 1.4% down. Could this bounce here? Absolutely. Do I expect it? No, but it could. And that's why I gave you 3 scenarios. How about the diamonds? I don't even need to open these up. Broke down between the June highs, failed at the 200, knifed through the 50, was down 1% on bigger volume on Friday. It just seems to me like a retest of the June lows is in the cards. What about the Russell? This was holding up better, but it not only did it fail on Thursday, it failed to retest of the 50 on Friday. I'd expect it to go back at least down here and test this low, but I'm expecting it to come down and test the June lows again as well. Hope not, but that's kind of what I expect. If I look at volatility in the market, just look at UVXY and see if it looks any different. UVXY. That's because a Z and a V are not the same, Jeffrey. UVXY. Here we go. And the same thing, although it's, was a positive day, up 1.48% on Friday, but still, you look at the volatility. Volatility hasn't given you anything. And then the dollar, which had been up, just open up the dollar here, and looking at this multiple top, it broke through, tested and held. So strong dollar, not great for my stocks or your stocks either, unless you're holding UUP. So again, betting person, I'm not. I think the most likely outcome here is outcome 3 and a bounce off the June lows. Gold and silver popped some as the dollar was a little weaker. We go back and look at Friday. It came back at the end and closed up, but it did trade down earlier in the day. Excuse me. We can see gold and silver both moved up. USO was bouncing on its 200-day moving average, and natural gas had a reversal candle after selling off and then closing back at the high of the day. And then the other thing, I guess, if you want to be bullish, is we came down some on the 10-year. So I've shown you only 2 things so far today, maybe 2.5, that are bullish or potentially bullish. The fact that the rates came down a bit is nice. The fact that we're oversold by buckets is nice, but I'm not seeing a lot of other bullish signals here that tell me to expect a quick move. Speaking of signals, my weekly market timing, whether you use the WMA in white or the SMA, 40 weekly SMA in yellow, stocks have broken through both moving averages. If you look at the spiders, the Qs, the Russell, and the diamonds, and the weekly bongos have turned red. So we got a sell signal on again. Slow but reliable, that's a sell signal. If I look at market theme, and I'm on just the short-term charts, during the market sell-off, we saw big caps and value outperform. And if we're looking at the hourly charts, the fact this is heading up of late tells me big caps are starting to perform. And the fact that this is coming down is telling me that value is performing. Notice what happened off the June bottom. This happened off the June bottom, and that was supporting small caps. This happened off the June bottom, which was supporting growth. But now we're going the opposite way to large caps and value, which is defensive. I like my ratio charts to give me a sense of what's working, what's not working. These are ratio charts hourly versus the spider of the S&P sectors. And if I stand back, the stars are clearly utilities, which can never be good because they're so defensive. Discretionary is holding up pretty well. Financials moved up some, and industrials. But look how technology, especially with that latest news on semis, has rolled over. If we go into the bull scanners, and I'm not here because I'm bullish, I'm here because I like to look at potential opportunities to the long side. Start by looking at the heat map. Yeah, you can tell right away. It's kind of red. And what wasn't red? Occidental Petroleum, Exxon, Chevron, and then some software and Salesforce, Morgan Stanley Financial, Citi Financial, and ConocoPhillips, another energy play. If we look at sector scanner for just Friday, let me return here. We can see energy, basic materials, and industrials led. On the week, the only thing up was industrials. Now, why would I have a positive on weekly here? And then I told you before that all the sectors were down. Well, on the S&P 500 stocks, all the sectors were down. S&P 1500 stocks, all the sectors were down. If we look at on the industrials, on the large number of stocks here on the industrials and others, this is the whole universe. And on the universe, industrials were up a tad. It's really hard to find things I'd want to follow on the bullish side. But if I just looked at daily algos and I did the energy, industrials, and utilities, three of the things that we just mentioned before, and I hit compare, I look at daily algos. I'm not even going to touch this one because something's, well, I can touch this. It's only one. Waste management. These numbers are so low on the algo scores. I'll go down to 5. Now let's just look at the weekly algos. Let's add a couple more. Use some utilities. All right. Now we're going to go compare. And we're going to look at daily algo scores. And let's just go down to 500. We can go down further because there's not that many here. We'll go down into 400. Let's hit them all. And let's add that to my weekend review long, default watch list. Okay, so let's just go here, add them to the watch list. You want to always see this happening up here. Now I'm going to go into Wealth Scanner and just look at if there's anything, forget just the what's on fire, but is there anything that's going to come up on the weekend review, bullish? On the first thing I showed you under hot stocks, I don't want weekend review, that's too big. I want my ETFs. But what I showed you in the first one was just things that had flames. All right, so short the bonds and the dollar, short ARK, short the Qs. Here's energy, natural gas, production, and utilities, oil services, and volatility. Now notice how little these numbers are. So really the only things showing strength are shorting bonds and the dollar. That's not really very bullish. Now if I go to my CAT scanner and I look at that weekend review, which I'd already built out many things before, you could see that on the current filter, which is looking for 5 and 500,000, they have options. Minimal liquidity is fine for the scanning. At least one bullish dot, no bearish dots. And I'm looking for stocks that were short term. Their daily bongo was red, but it flipped to green sometime within the last 2 weeks. And their weekly bongo is green, which should be down here. There you go. So not many make the list. This is about as low as you're going to see. There's a couple here that I thought were interesting. GHI, Guardant Health. These guys can take a drop of your blood. If you have cancer, God forbid, I know this company well because that's the business I'm in. And then from that drop of blood, they can tell me your cancer, which is somewhere else in the body, if it's in your lung or your colon, they can tell me what genetic mutations are driving that cancer from finding cancer cells in the DNA circulating in the blood. That means as a cancer doctor, I don't have to send that patient for another biopsy. The stock has sold off hard. You could see it was $130 stock in September. It's moved up on the weekly, so the weekly bongo is green. It's been in a squeeze going back for, gosh, over a month. And it had a breakout on volume and momentum on Friday with relative strength and OBV turning up on very good volume. Read the news. Now, it's going to have lots of overhead supply and really going to have some challenges around this 200-day moving average. But this is one of the better looking things that you're going to see. Chegg, which is, I think that's college kids and renting textbooks for the semester instead of buying them. Seems like a no-brainer business. Back in the old days when we were Zooming for school and this was a way to get your books, February 21, the stock was $115. Then we got vaccines and the rest is history. It's making a stand here. Also volume, breakout on volume. The weekly bongo just hit. Relative strength and OBV are favorable. Sting, I mentioned energy shippers. This is one of them. This is in a nice uptrend here. And you could see a breakout momentum in a squeeze. All three bongos are green. So those were some. Agios was one we talked about during the week, one of the biotechs that broke out, and this continues to move up higher. Boom. But really looking at this list, is there that much here you want to buy? No, there's not even that many choices. In fact, I probably had the least number of buys in ages. Now, what about the bearish side? We can go to the bearish scanner, do the same thing. Let's go into sector scanner, and let's look at daily algos that are red. What are the weakest? Real estate, communications, cyclicals. All right, compare. Let's get the worst. Recreation. Keep going down, go down about 10 or so. Now let's look at the weekly algo score. Capture any of those that made it through. And this is a top-down way of building a list of bullish from the prior side and bearish. All right, this is enough. Now let's see what my default watch list is. We want weekend review shorts, apply. That goes up here, success. Let that finish. And now I'm going to hit, see, I'm going to go compare these to bring up the stocks. Now let's take the worst of the stocks. Those are the best of the stocks. And let's go down to 450. All right. And now let's add these to the watch list. So now I've created a list of stocks that are in the worst sectors and the worst industries and have the worst algo scores. So now I'm going to go to Wealth Scanner. And let's just see what is on the bearish side of my top-down indices. See, healthcare, pharma, when we talked about Bristol Myers, I think last week. Construction, ARC, bonds, communications, same types of sectors that we just built. Let's go into the CAT scanner, weekend short review. Let's rank by dots. Let's see what we have. CME. So obviously this was once a big player. Pulled back up, really didn't rally that much. Failed at the 17, and is it coming down? Well, you got a breakdown with volume. All the bongos are red, the relative strength, and the OBV are coming down. And notice how it is broken down below all its moving averages. Lilly is a pharma stock. This has broken down. Now, you could argue and be right that there's probably support in this area, but this has failed, the 17 and the 50. My guess is Lilly's coming down to the 285 range and testing the 200. AstraZeneca, another healthcare stock. This is what happens when you retest and fail. Broke right through the 200. I've actually built a small list of stocks that I thought were potential sells this week. Let's see how many of them will show up here. Only one, so let's just go to watch list. And these are some of the stocks that I thought looked to be in places that could lend themselves to further downside. Here is ASML, an expensive semiconductor that, considering the news that hit NVIDIA and AMD, it's already in a significant downtrend. Domino's Pizza, you think if your income is dropping, you're going to eat more pizza, but this is broken down. And, a retest of these lows, at least a 10 to 15% drop. I'm not going to go through all of these. J&J is another pharma stock. Why did this one show up, and why was I thinking about this? Because it traded up to that 17 and failed. Looks like it's starting another leg down. LPL is a brokerage house. Not a bad looking stock. In fact, this could turn around quickly, but if this is rolling over, it could drop all the way down to the 50 and more. So these were some. Verisk, a shipping stock, has broken down, failed at the 50. Is it going to come back down to here? That would be my target. So these are some of the stocks I'm looking on the short side. If I go to the bullish scanners, show you some of the stocks I'm looking at on the long side. There's not many there, and I'm not advocating you spending your money on the long side or the short side, because I think this is a market that could bounce soon. Some of the ones that, like CEIX, nice uptrend, pull back to the 17, might be in, look at that bottoming tail there, might be ready to go higher. CommScope has been showing up. It's probably already gone too far, but this is a leader right now, one worth watching for. Futu looked like it was teasing us when it came back, but it broke out again. And when you consider the weakness in the market on Friday and Thursday, breaking above on the weekly as well. Holley Systems, an automation, a big gap up on Friday. The stock looks like it's poised for more move. Look at that volume. So let me just refresh my thoughts. We are in a dangerous part of the market. All right. There is a chance we go higher from here, and you have a chance to buy things really cheap. My guess, my hypothesis, I'm not reading tea leaves, just based upon experience, is I think that this the June lows is a very likely destination for the markets. One would hope that we bounce and try to rally back up to the 50 and the 200 day. There's no guarantees that will happen. So let's just look at what this looks like to me here. and I sort of hinted at it last week. Leg down number 1. Leg down number 2. And are we in the midst of leg down number 3? What I do know is that this is likely to be the biggest drop of the 3 legs. If that's the case, this is the January or February 2020 highs, depending on which market, and these are the lows. We're not going down, I don't think we're going down 50% from here. But could we drop from 392 to 340, another 15%? Yeah, and I wouldn't surprise me one bit. So, I am not a perma bear. I'm not a perma bull. I look at the odds, and that's going to impact how I'm going to trade. If I'm thinking that that's a possibility, then I've lightened up positions, I've raised cash, and if you got FOMO and you got to be buying something to the long side, there's always going to be a story stock, a biotech with positive data, an approval, a takeout. But you might also be starting to think, if you're not already there, and I've been talking about them on my dailies for some time, the Contra ETFs. Is it the dog that goes up when the Dow goes down, breaking out above the 50? Is it SARK that goes up when ARKK is out of favor? Nice move up. Is it SDS or SPXS, which is leverage, that breaks out and moves when the S&P is going down? Is it SOXS that goes up when semiconductors go down? Is it SQQQ that goes up when the Qs go down? Is it TZA that goes up when the small caps go down? So there's a number of ways of playing this market. The only reason why I haven't loaded up the boat on these Contra ETFs is we're due a bounce. And look at what happened in here. We bounced right up to resistance and came right back down. So would it shock me to bounce up to the June highs, fail, and come right down? Absolutely not. I kind of expect it. So enjoy the rest of the weekend. Have an awesome Labor Day. And do yourselves a favor. Protect your capital. Been here before, done this before. And when we get this massive March 2009, March 2020 bottom, you want to have cash left to play. FOMO kills in this market. Have an awesome Labor Day.